Yeah. So after this black line, the last day we had a lesson, we seen up that black line. Yeah.
Staying in Solana.
And Solana, we'll go back to Go. I thought briefly show you the structure and I get your mind jumped on. Yeah. So this is these three, well, two assets, gold and Solana, will continuously do the structure and keep up to date to it to see the yeah. So look here, obviously then the consolidation. Yeah. And this is basically when we were doing our lesson. Yeah. So then the consolidation, he broke out of it, follow the market, and this you could say is a little minor higher high as well. Yeah. Not like a normal, not that's not a clear one, yeah, but it's still a minor one, like just have little pay attention to that, yeah. And then your high low is your little one there, but again, that's minor. Don't take that as like a a proper one. Like obviously that's consolidation, but these ones, these ones are proper ones, yeah, because they're clear. They're not clearly defined. This is like just pull back one candle and then it went. Whereas these ones, it's like it consolidated 2-3 candles, then it pulled back a good few candles, and then it continued here, consolidated, then pulled back quite a lot of candles. Then here, this high low consolidated, and then it went up and it flew off. Yeah, it wasn't just like this one again. This is a minor one there. There's only one candle. But if I pull it up on the 5-minute, if I just even do that now, yeah, let me highlight that. If I pull that up on, say, the 5-minute, I think, yeah. Where's the number? See, look on the 30-minute, I said it's minor, yeah, and it is minor. But on the 5-minute, can you see how it's much more clearer? Because the 30-minute in 5-minute it turns into 6 candles.
Yeah.
Do you get it?
Yeah.
Can you see how now here it's like that pullback is a few more candles in consolidation? Do you get it?
Yeah.
But in crypto, personally, I don't think you should do smaller time frame. Minimum is like 30 minutes because crypto is like it's very volatile. Like, actually, great thing you said the other day. Suddenly, it just shoots up or goes down or whatever like that. Yeah, that's why if your analysis is done on the 5-minute, if it just suddenly just shoots down or goes up, yeah, you could get caught up. Whereas if your analysis is done on the 4 hour, 1 hour, like that, for the market to do a big enough random move relative to the 4 hour, 1 hour, it takes a lot more than on the 5-minute. You just have a fat candle. Do you get?
Yeah.
You get what I mean?
Yeah, it makes
because a 5-minute fat candle, on the 1 hour is not going to be
nothing.
Not nothing. It could still be decent, but not like
yeah.
going off the whole page. Do you get me?
Yeah.
Like you see this massive bullish candle.
Yeah. On the 30-minute, that's quite a big.
But going to the 4 hour. If our analysis was we done the 4 hour and we came to the 30-minute on the 4 hour, that's like minor.
It's not
minor.
Yeah.
But if my analysis was done on the 5-minute or the 15-minute, and then suddenly it just does a crazy move, then because my mind is on these small time frames, I'm getting caught by the random manipulations. That's why QBank, Bernie, these lot, they done well because they're heavily focused on from top down. I'm doing daily, weekly, whatever, 4 hour, and then I'm coming to the 30-15 minute. So if on the 30-15 there's manipulation happening, it doesn't matter because my analysis is on the bigger time frame, so I know my bigger time frame is right unless X, Y, and Z is not, is broken or something like that. You get it? So continuing from that dotted line, yeah. And remember, you need to get freaking with that. Yesterday on the phone, we're having a laugh, yeah. Stretch the chart. Look, if I do this, yeah, how does that look?
Yeah. You know when I did that yesterday and you changed it, it's gonna stay like that, yeah.
It should stay like that.
Okay. Because you're right. It does make a huge difference.
Look at that, yeah.
Visually,
look at this, yeah.
Yeah.
Okay. And now let me stretch that and zoom in as well. Can you see how this looks much more
clearer?
Like
you can see what price is doing a lot better.
Not only that, the you're talking about language, yeah. This is like it's speaking to you, yeah.
The accent is clearer.
Yeah, it's not but ding ding like you say, yeah. And this one is like, some but ding ding or some Irish guy or Scottish guy is like, I don't know what he's you know what I mean? And what you're doing is some few words you understand, and the middle ones you're just putting it in there from the full sentence in it.
Yeah.
You get it? Because you don't understand it fully. But one is like, Queen's English, the guy speaking very nice, clearly, and word for word exactly what the guy is telling you, yeah? So look, these are minor ones, yeah. And here, that's your first structure there, yeah. First one, it happened there because then it pulled back. That's where we would draw it after it pulled back, yeah. Yeah. Are you following me? We're on this candle, yeah.
Yeah.
And then so that's we can draw a box there already, yeah. So I would have done it there in real time. We would have done it there, yeah.
High.
That's your high, and then okay, price went up, came back here and rejected. So now I'll just extend that out, yeah. And price came down, and this is like a double, they call it double top, or relatively equal high or whatever, yeah. It's come down, and then this is a minor one, yeah. But your next one where you don't want price to cut through is that, yeah. But that is your first line of defense. I think yesterday the other day we briefly said it, yeah. That one, if it cuts through that one, yeah, we're not like that thingy, yeah. And remember, I need to make it clear, yeah. No, sorry. We're here, like price is coming down here, yeah. So actually, let's cut this out. Look. Delete that. That last candle there, that's where we are. This one there, that's yeah. So this one we've already drawn that. We've just stretched it out. This one we've not stretched because that's just a minor one. Yeah. So price can come into there and want it to bounce off. Yeah. If it breaks through there, still we're bullish because that's just first line of defense. You can manipulate through that to catch out people. We said the buy sell liquidity is there. Yeah. People got their stop losses and that whatever there. Yeah. And
so basically, like Bernie said, breaking a trend doesn't mean the structure's broken.
Yeah.
That basically.
That's
what
it.
You're saying, yeah.
And not only that, after breaking, we're going to retest and continuation. Remember the example a few days ago where it retested, but it didn't continue dropping. It went back into the trend. I think it was Bitcoin or something we're looking at, yeah? So look, so this is your actual one where if it breaks through this one, then you want to be a bit worried, like, okay, I need a retest and a continue, then I'm cutting out my buys, yeah? Or closing in a loss, yeah? So let's follow.
Alright, yes, it's best to take that.
Let's follow the market. Okay, when market pulled up here, we put that box there, yeah? Because that's like a low, yeah? Can you see?
Yeah.
Would you identify that as well, or not? Don't be yes or no.
It's parallel to that as well.
No, it's just this is minor. No one cares about that. As price is going down, is price pulled up, and what is that they call it?
Equal low.
No. These last three candles. Yeah. What is that? The beginning of a consolidation. Great. And okay, so then now because of this big bullish candle, we know that's definitely like a higher low, yeah. Because now the market did nicely pull away from it, yeah. Okay. Now after this second bearish candle, then we can put our box there. Remember these boxes, once we put them, if as price moves on, we could keep the box, or because if price does something where it's like, okay, no, that is wrong, then we delete the box, innit? You get? Yeah. Like if price just flew through that, then I would just say this is like a minor high, low, high.
And then take the box off.
Not take the box off. I would take the box off, or I'd leave it there, but remember, or change the color that it's a minor one, yeah? Okay. Because the pullback is not deep at that moment, yeah? Yeah. But obviously it was a proper, so that is a nicely defined one, yeah? Because look, it's clear as day. I remember, that was a great thing, yeah, on the spot we did yesterday. Yesterday, what did we do after you drew the boxes? What did I tell you to do? When you drew the boxes on the phone, and then I said to do something physically. Oh, what did you do?
Tap myself on the back.
No. Oh, after that. What did you do? I can't. You stood up.
I stood up. Oh yes, yeah. I stood up, went back, like, so I could see it clearly that these are my structure points.
The main thing was that all the way from, like, I think it was 7 or 9 steps. You could see from there that because you drew the box, that is the high, that is the high low. Yeah? If those boxes was not there, from those 9 steps away,
those are my key levels.
Yeah, you're following the market, yeah. But if you didn't have the boxes there, from the corner of the room, it would have been like, oh, you know what I mean? Yes. If you're experienced, then obviously it would have been like bullet, yeah. But and even if you're experienced, it just makes it. You don't need to use much mental power.
It gives you that visual edge there.
Because the box is there, it's like I don't have to think about the resistance is there. Rather than I have to use my brain, like, okay, yeah, that's the high, and then it makes your brain have to work more.
Yes.
It's just a visual aid.
Today I'll go and do that actually straight away.
So okay, price cut through this, yeah. But you're not gonna use, price cut through this high there, yeah, and it's like equal high kind of thing there, yeah. Price cut through there, yeah, but we said that's first line of defense, yeah. And this one, if it breaks through that, when retest continue, then we'll cut the buys, yeah.
So no retest yet.
It's come close. It's cut through.
So it's going down.
But remember the retest and down, yeah. So what we're looking for is this.
We're looking for a buy in it.
Actually, it's a good point for a buy, but as in terms of if we're already in a buy from before, a few days before, whatever it is, yeah, then this is like where we want to cut out of it if it retests and continues going down. Of this one, yeah.
Yeah, because it's been getting lower lows.
Yeah, if it breaks this next, because it broke that already, but we're not gonna get like scared of that. That's just minor, yeah. This one is like, okay, if it breaks that and retests that, then it's like, okay, we need to cut out from buys, whether we're in profit or a loss, yeah.
What do you mean, like, if it cuts, if it recut, I mean, if
it breaks through there,
and then goes down.
No, if it breaks through there,
and goes up.
Look, I'm gonna draw it. Yeah, look, there's your box. Yeah, price come down.
Yeah.
Retest.
Yeah.
Doesn't have to be to the box. Like it could go back up.
Yeah.
But ultimately, then go down.
Oh yeah, I understand. Now.
Do you get?
Yeah.
Here.
Then we need to cut out.
Here, here it's like it came, broke through it, but at that current moment, because I've not revealed the rest, it's only gone up. It's not done the, what's the other bit, the continuation in it.
Yeah. So it's still possible.
So it's still possible that we're still bullish, and if it is still bullish, then what should we do? Going for buys, isn't it? Because we're in a good place to buy. Because look, market has dropped all of that. Yeah, the whole thing in the market, you buy cheap, you sell expensive. You sell expensive, buy low. Like so, when you go in short, you short a high price, and you sell it, you buy it back. You know how it's done at the lower price. And when you go long, you long from low price and sell it off at the higher price, innit?
Ideally, yeah.
That's how the market works, innit? Obviously, in traditional business, you don't sell something from a high price and then buy it at the low price. That does not work like that.
No.
But in this is how the contract and how trading is done. It's different. Like I've said to you, look, I'm predicting your price is going to go down. So you give me the mal, and I will pay you in 10 days if the price does drop. But if the price doesn't drop, then whatever the market price is, if it's higher, I'm going to pay you that, and obviously I'm at a loss. Yeah. Do you get it? Like say your thing is 10 quid, and I say in like soon it's going to go to 8 quid, yeah? So it's 2 quid profit on my side, yeah? And I say to you, give me the stuff, and I will pay you 8 quid, yeah? Obviously in traditional business, that is not how it works. But that's how trading, stock trading, any trading is like that, yeah? Like financial market trading, yeah? Now, when it goes to 8 quid, I pay you 8 quid. But that thing I got off you that is worth 10 at that time, and I've sold it off whatever it is, I already made that 2 quid, but then I paid you back the 8 quid later on in it. And I made that £2 profit. Whereas if the market went to 12, now I told you I'm going to pay you the price at that time, and instead of having to pay you 10, I'm paying you 12 now. So I'm out of pocket by £2. Okay, that's how this trade. But that stuff is not necessary. You don't need to really know about that because it's already doing that phase. So okay, look here. It went up. What is that doing?
High.
No, here.
Consolidating.
Very good. Continue consolidating.
Yeah.
And then we've just done a box here because this is also a what?
Consolidation.
Besides consolidation, what is that?
It's a high.
Yeah, very good.
Besides that, it's a high as well.
Because that's
so they can be both. It can be a high and a consolidation.
Yeah. Because a consolidation can happen at a high. Can it not? And a consolidation can happen at a low. Can it not?
Yeah. And then
it's like two together,
Yeah, absolutely, yeah.
So then it came back here and went up. Yeah, obviously after it shot up on that one, yeah?
Yeah.
Like you've done your box there.
And we're only 30 minutes, so yeah.
Obviously, but like I said, crypto is, you're not trading 5-10 minutes or an hour. You're catching trades 5-6 hours, 10-12 hours, 2-3 days, you know. That's how crypto is. to avoid getting manipulated out of the market. And not only that, because you want to make the big money, you gotta move with the bigger moves. And you don't want to sit there like that example, yeah. You made £1,000, and the next guy had took the same trade, but he held it for longer, and he made 10 grand. In that example, that hurts a lot because 10 grand is like
10x.
A
What
big,
I did.
forget
And
the
like
10x.
he could have done that as well.
No, the monetary value, 10 grand is like say 2-3 months of bills, yeah.
Yes.
Whereas a grand is like half the month bills or something like that.
Yeah.
Nonetheless, a grand in one trade in a day, in a week is fantastic.
It's a big difference. But
It's
in
like
hindsight, you're looking at it.
the main thing is you took the same trade as the next geezer. The next geezer, all he done, he held it a bit longer than you did. 1 day, 2 days, maybe a couple of hours longer than you did, yeah. And you've seen that the last 2 days in your gold trade, yeah. Whereas there is literally someone out there who took the same 003 as you, and he made 10-15 quid times 2-3 of them, yeah, and he done 40-50 quid profit for the night, and you closed up at 10 quid, 5 quid. But you see, obviously in that example is the money is smaller, but in that example, a grand and 10 grand, that's like, you know what I mean, big thing, man. Like a grand, are you going for a chiller and leaving money to your wife?
Nah, right.
But if you do 10 grand, you give 5 grand to her, you earn 5 grand this year.
Exactly, yeah.
So that's the difference with the. You want to catch the big trade, and lately I'm realizing like forget about the smaller time frame. You wanna not you can trade in the small time frame, but you still got to do your analysis from the bigger one and try to catch the bigger move, because the bigger move, that's where your bigger money is. You're catching 100 pips. 100 pips is more than bloody 10, 20, 30 pips. Obviously it's relative with your risk reward, but you're doing it 30, 40 pip, 50 pip stop loss, and you're catching 200-300 pips. That's like 1 to 5, 1 to 3. You know, that's like you're catching big money. You know what I mean? And if you're doing a 5% risk, 1 to 3, 1 to 4, that's like 15-20%. Whatever the float is, you got 10 grand float. There's 2-3 grand, 4 grand. If you're doing that 1-2 times a week, or just 1 week every week, you're doing 15-20%. At the end of the month, you know what I mean? You got good money, 10-15 grand a month. I remember what we said, 300 pips a week. You can't do 300 pips a week in cable or Euro USD or AUD USD, and GJ it's a push because it's coming to the edge of it. So then it's not. You want to do something where the amount is easily achievable within its range. Like the goal is doing 1200, 1300 pips a week. To do 300 of that is like a fifth of it, a fourth of it. It's not a lot. You're not asking for a lot.
No.
It's a low hanging fruit. But even then, you could have a week where you catch 500 pips of the whole week. You know what I mean? The fantastic week.
At 5%.
Look, and this how we can use the Fibonacci as well to catch the trade, yeah. Like, and the thing is, this is where you have to use risk and probability. Take risk, yeah. So when price is consolidating here and price is coming down, we're like, okay, we can get in the market at 2 places, yeah. And we can take both of them anyway, yeah, if you want to be like that, yeah. And QPAX does that. They do multiple entries about these guys, yeah.
Like yesterday when you made me do that, I was like, easy, man. I didn't think of that.
Look,
that's a good idea.
You get one in at the consolidation, yeah? Yeah? And this low here,
yeah,
you put the stop loss there, but like a bit lower than that. So if I double click it, how much is it? It's 372, yeah? 3 USD. So let's say let's put it at 5. How much is 5? Yeah, 5 is below. Nice. Can you see it's a nice gap below there, yeah? And we're aiming for 10 anyway, yeah? We'll aim for 1. That's 1 to 2 risk reward, yeah? 1 to 2 risk reward, yeah?
Yeah. That's the other thing.
And another entry is where's your from here, where is your high going back following the candles?
There on this one.
Okay, very good. And for going back, where's the low?
Going back is the lows here.
Lord, yeah, that's quite good, man. Draw Fibonacci from low to high, yeah? And look, if we follow it, the 63% I said, yeah, is like your, well, the golden ratio is 61.8, but I've modified it to 63, yeah. And there you put order there, and again you put this, put the same stop loss as the other position, 173.11, yeah, 173.11, yeah.
Yeah, I'll work this 50 now, man.
It's not complicated, man. You just have to draw it and it tells you everything you have to do.
Yeah, now I can, after seeing you a couple of times now, I can see the simplicity of it.
Look, we got one entry there, because in case from there, if the market, let me
reverses.
no, let me Let, if we were here and the market just flew up from, obviously not in one go, but like if it just went up from there, and if we were waiting for it to pull back more to catch an entry, then we missed the move. In it. So what we do, we'll catch an entry there, do the stop loss so that if it does pull back, we're still in that trade. And if it does pull back, we'll drop on. You know what I mean? We were here to make money. We're not here to start crying like, oh, I don't do too much. Like Kubangi says, did you come here to make money or be like a wuss and do minimal risk and this and that? You know, I don't like that monkey tongue, bro.
I'm on that level.
Like, if you're here to make money, be aggressive. Yeah, like. Yeah, you know what I mean. So, and if it does pull back, what am I gonna do? I'm gonna go for another trade, bro. I'm not gonna be like these. This is what this online people, you have to take their knowledge with loads of pinches of salt, a bucket of salt. Yeah, might do 0.5% risk and 1% risk, and only do one trade a day. Tell them, show me your millions in your bank account, then I'll say, okay, you know what, you got great advice, yeah. But if he's not got millions in bank account, don't worry, I'm gonna follow the guy who's got millions in bank account, and he's telling you, no, bloody flipping, do a higher risk. Even that Moroccan guy, Sammy, who I tell you about, in from Canada, he does the same thing as Q. He don't got one entry, he got 2-3 of them at different points. But your geezer who ain't even got 100 grand in his bank account and he's got a YouTube channel for trading, he's like, no mate, 0.5% risk, and if you do 2-3% a month, you live a nice, mate, flipping it like you says, you want to change your life, not flipping like Turaram. You ain't got time to flipping do 2-3% a month. I like Q-Bank style, like, we want to do double, triple the account in a month, bro, you know what I'm talking about? Yeah. So we'll go in for another trade on the fib if it does retrace. If it doesn't retrace, we still got in the market there, innit? If it does retrace and we get in there again, fantastic, you catch a good trade. And if it goes and takes us out, we accepted the risk. Yeah. That's it. You gotta take risk to make money. That's right. And if those both work out, then you know what I mean, you're throwing money to the wall. Yeah. And the first trade, that's 1 to 2 risk reward, yeah? So you're doing 5% risk, 1 to 2, 10%, yeah? On a 10 grand float, 10% is a grand. Yeah? And the other trade, that's better risk reward.
1 to 2.
1 to 2, 5% risk, 1 to 2.
It's 10. It is a grand on 10%. I mean, it's a grand on 10 grand.
Yeah. 10% on a grand is how much?
10, yeah, grand.
Grand. On 100 grand, how much is 10%?
Yeah.
It's not a bad number. Yeah. Relative. Yeah. I remember we're banging another entry. Look at risk. This one, 1 to 3.82. So we put in a grand risk there. We're getting 3,820 quid plus that one, which we're getting
a grand.
Sorry, a grand, and this is half of that. So that is 1,500 plus 410. We're getting 1910. 1910 plus 1 grand, 2,900 and was it 200, 2,900.
Bad day, good day at the office, mate.
Good week in the office. Good week. You're doing 3 grand in a week. It's like basically for the week. It's a week trade.
That's a month. Yeah, that's a
month. And relative to the flow, that's a fantastic percentage.
Yeah, for the flow, that is like sick, bro.
You're done. You're done about 27%, 26%. That's like on 100k float. What's 26% of 100k float? 26 grand. On $1 million, what is 26%? You buying a house cash. You're buying a house cash. And obviously, as your float is growing, and still it's like 2,900 is not like it's less money.
That's the thing I noticed, man. It just takes a bit of time. It doesn't take long.
And look,
no other business like this, man.
Yeah, and look. Obviously, it's not hit TP, but like we're in profit.
Way in profit. Yeah.
Like, we're sitting nice.
So would you cut out there or would you write it out? Because you see on the left, you can see that, you know, we've twice it retested, innit?
Yeah.
So what would you do here? Would you take?
No, but we're looking at obviously that as well. But in current price, what is happening in current price?
It's still going up. It's bullish.
Obviously, not just that, but look, price it broke that, but ultimately it rejected that. Like it didn't cut through that, so we're still bullish. Yeah. If we're still bullish, why are we gonna cut out of a trade? Yeah. Not only that, look, it pulled back and look, it's going still bullish.
Going up. Yeah, we're confident. Okay.
And we're not cutting out of this trade until it breaks this and retests that. Yeah, that's your second line of defense. Your first one is like this area, yeah? this area. That's your first one. But obviously, as price is going now, it's like we're in the clear. But look how people take people out. People who got in the same entries that shot up, they put their stop loss to break even. This is what Q says. I don't put stop loss to break even. Look, you put your stop loss to break even because you're in profit. You put your stop loss to break even. You put your stop loss to break even, and then market pull back.
Risk management, basically.
You got taken out of the trade. But then what happened to the trade ultimately?
Went up.
But you got taken out because you put in break even. That's why Q Bank says, when I take a trade, I accept the risk. I'm not gonna put in wholly. I'm not gonna put in break.
I used to do that because I used to watch you do it a lot.
Yeah, I used to do that, and
all of us used to do it. And I think he used to, Roger used to do it as well.
Yeah. But Q Banks,
but I never used to understand it.
Q Banks is a different style of trader.
Yeah,
it's
not like his,
not even different style of trader. When you're trying to catch a big move, you have to let price be able to fluctuate and move around, play out, yeah, ultimately. But when you're catching 20, 30 pips, 40 pips, then you can do that break even stuff and whatever like that. Because it shouldn't take too long to play out. Do you get?
But it's good risk management.
It's good, yeah, it's great risk management.
So it's looking at it from both ends. Looking at from.
But it's the mental capacity in it. Say you took the break even. Now it takes a lot of mental power to enter the trade again. Because now in your mind is a fear of, what if I enter again but it's a losing trade? Your mind, you can't go back in time after seeing you went bullish and into the market again, you know. In that time you're like, okay, I took a break even, I didn't lose anything, but like if I enter again and it didn't, and it's a failed trade, then I'm gonna lose when I could have just sat break even. Yeah, not mentally.
Yeah, from a risk point,
people can't handle it. Yeah. Whereas, would you not rather just that first trade is running with that normal stop loss?
Yeah.
Do you get?
Yeah, and just write that out and see what happens, isn't it?
And the thing, like you says, I accept the risk in it. You put 100 quid risk. That's it. You're gonna lose it. If you don't lose it, you don't lose it. Innit? And if you're a good trader, it doesn't matter. In the long run, you're gonna be profitable overall anyway. It's like this risk reward stuff, yeah. You lose $1,000, you're gonna make that grand back in it double. Let's look at gold. Yeah, go through that now.
Well, we have to leave.
Oh, okay.
It's 4 o'clock. I'm just gonna go to the bathroom. I'm ready.
I already drew anyway, yeah? I moved last step. This is start, consolidate, dropped.
The gold you're doing,
yeah? It went up. This Asia session, yeah? Went down, and I've drawn the boxes, yeah?
Okay, actually, let's quickly done that.
And there, up there, you've done your high there, and then it dropped. It broke out of this one, yeah? It broke there. But look what it done there. It done that. What's that thing we talked about?
First line of defense.
Yeah, but then look what did he do? What's that?
Retest.
Retest and then
Went down.
you continue dropping. So you take a risk on a sell. Obviously, you did take a sell, yeah. But like, look how many we catch nicely.
What did that do yesterday? 150 pips.
150 pips, yeah. Well, the full session, yeah. But look, from there you catch.
That was the other question from one night, and I was going to ask that. When do you take? I come with a lot when I'm driving. When do I take the trade?